Some of us who are old enough to remember Nakumatt, which was once the biggest retailer in East Africa. Anyway, it went belly up according to the founder because the government put in a law to cap interest rates that banks could charge for lending. So banks just stopped lending to businesses. Mix that in with two major banks going bankrupt, and Nakumatt's debt-fueled growth stopped in its tracks, and it collapsed under the weight of its own debts.
It's quite interesting, but you know what? It's really worrying. Interest rates are still pretty high for businesses in Kenya and across Africa. And let me tell you, access to credit is crucial for any business. Think of credit as the blood that pumps through a business's body, keeping it alive and growing.
Yes, it is. But you have to go a little bit deeper. The lending rates are so high because the government's actions result in financial repression of the population. Let me explain. If you're a bank manager and you have two options, loan an entrepreneur at 18%, which is still high, mind you, and take the risk of their failure, or loan the government at 18%, since there is a very low chance they will default.
Charlie Munger has an astute idea about incentives, He says, if you show me the incentives, I'll show you the outcome. And you know what? If I were a bank, I'd probably prefer to loan the government over entrepreneurs because of the incentives the government's put in place. Low risk and higher returns, it's a tempting deal, even though I know it may hinder the small businesses that actually drive the economy forward.
Exactly. That seems obvious, right? That's exactly how incompetent African governments gain loans through these financial instruments like infrastructure bonds that are bought by wealthy private citizens and institutions.
And here's the kicker. The government's appealing loan conditions often lure lenders away from entrepreneurs in the private sector. The perceived lower risk combined with the convenience of lending to the government means entrepreneurs struggle to secure funding, leaving the private sector starved of crucial capital.
For sure, and the history tells it all. When other countries like the US, China, and South Korea, which are developed now, were developing, their leaders ensured that business credit rates were always in single digits to low teens for riskier borrowers. In Africa, the average lending rate is 20 to 25%, double the rate in even developed economies.
High interest rates can make a huge difference in whether a project is profitable or not. For instance, imagine a project that's doing well at a 6% interest rate. But at 25% interest, even if the margins are the same, the project might start to lose money. This shows why it's so important for businesses to have access to affordable financing options.
Very true. And I think there's a major issue that's faced by my country, but across many African countries as well, that there's no unified vision or ambition to industrialize in a generation, like there was in these East Asian miracles we keep hearing about, like Singapore, South Korea, and China, which were able to go from third world to first world in less than 50 years.
Fair point. But weren't some of those countries that experienced rapid development also led by single parties or dictatorships that were in power for extended periods?
Yes, but Africa had many long-standing political parties too. Think about Kenya. If you're Kenyan, you probably are familiar with KANU. KANU was a political party that took us to independence in 1963. It stayed in power until 2002. We can't even get dictatorship right. I mean, at least with South Korea, they had a dictatorship, but it took them to the first world.
You know how the saying goes. There's a reason why Africa's got a reputation for having leaders who don't really measure up. But let's dig deeper. There must be more to this struggle to build and hang on to wealth than just bad management, right?
Of course there are, Nia. Welcome to Africa. We also happen to have underdeveloped financial systems and investment instruments that help preserve wealth. These stats are scary. As of 2022, only 49% of adults in sub-Saharan Africa had an account at a bank or mobile money service, though Kenya is higher at an average of 80%. But here's what's truly crazy. Even those with financial access have few viable avenues to invest. Local stock markets are small and participation is shallow. In Kenya, for example, there are around 1.55 million stock trading accounts, but a stunning 97.5% of them are inactive with only about 38,600 accounts or 2.5% trading in the past year.
Here's the deal. Investing in public stock markets requires trust in the system, right? But sometimes it feels like people are just shrugging their shoulders and walking away. Maybe it's because they don't understand the market, or maybe, just maybe, they don't trust it to deliver returns. You really can't blame them. Africa's stock markets have been like a roller coaster, up and down, left and right. It's like they're playing with your money like it's just monopoly cash.
Those are valid points, and I think most people have a sense of that. With modest bond markets and few low-risk investment funds, people tend to hold their wealth in tangible assets like real estate or in basic bank deposits. But these strategies have their own risks, like property which can be illiquid, meaning it's hard to quickly convert the asset to cash when you need it, but also low-yield accounts in banks can be risky since the value of the cash could be destroyed by the high rates of inflation that African countries tend to have, or even bank failures in extreme cases, like Imperial and Chase Bank in Kenya in 2015 and 2016, that severely affected depositors, many of which did not get their money back for a very long time.
Hey, if you like that video, click somewhere to the right of your screen to watch the full unfiltered version. All the best and thank you.